The last time the correlation between US Treasuries and the S&P 500 remained positive for 24 consecutive months, the global financial system was dismantling the Bretton Woods Agreement. Today, that same correlation signal has returned, shattering the 60-40 portfolio that has protected middle-class wealth for 4 decades. For 40 years, when stocks fell, bonds rallied, acting as a shock absorber. But in 2022, that mechanism broke, creating a rare double drawdown where safe assets and risk assets collapsed simultaneously. While retail investors are still trying to repair their 401ks with the same broken tools, institutional capital has quietly engaged in a massive rotation out of paper assets and into biological ones. Here at Finance Saga, we track the mechanics of money, not the headlines. And the mechanism currently driving the largest private wealth transfer of the decade is not speculation. It is a flight to physics. To understand why billionaires are aggressively acquiring assets that yield less than a treasury bill on paper, we need to visualize a specific mechanism map that we will return to 3 times today. Picture 3 boxes connected by arrows. The first box is excess liquidity, the massive expansion of the monetary base. This flows into the second box, yield compression, where the return on safe paper assets drops below the rate of inflation, guaranteeing a loss of purchasing power. This forces capital into the third box, flight to inelastic supply. This is the key. Capital flees things that can be printed by central banks and hides in things that are limited by geology or biology. When the yield on paper becomes toxic, the risk-free rate is no longer found in government bonds, but in assets that cannot be debased. This is not a new phenomenon. We have seen this movie before, specifically during the Great Inflation of the 1970s. Between 1972 and 1981, the S&P 500 struggled to deliver positive real returns after adjusting for inflation. However, during that exact window, the price of Iowa farmland nearly quadrupled. This wasn't a coincidence. It was triggered by the Great Grain Robbery of 1972, a secret deal where the Soviet Union purchased 10 million tons of US grain, exposing the fragility of global food supply. The market suddenly realized that while you can print dollars to pay for wheat, you cannot print the photosynthesis required to grow it. This realization decoupled the value of soil from the value of the currency, turning boring dirt into the highest performing asset class of the stagflationary decade. We are seeing the early stages of a similar decoupling today. The media fixation on Bill Gates owning 275,000 acres of farmland misses the financial logic entirely. They focus on the who, but ignore the why. Gates and other institutional aggregators like the Mormon Church or sophisticated pension funds are not buying land to become farmers. They are buying inflation-protected perpetual bonds. In financial theory, farmland is unique because it offers 2 distinct revenue streams: the operating yield, which is the cash rent paid by the farmer, and the capital appreciation, which historically tracks the nominal GDP. When you combine these, farmland has delivered a positive return in every single year since 1991, exhibiting a negative correlation to traditional equities during market shocks. Consider the Mississippi Delta and the aquifer-rich regions of Nebraska, where institutional buying is most concentrated. This is not a random scattershot of acquisitions. It is a calculated bet on basis risk. In finance, basis risk is the risk that an asset's value will disconnect from the price of the hedge. In agriculture, the basis is the soil quality and local infrastructure. By acquiring land in the Delta, investors are securing topsoil depth that took 10,000 years to deposit. This is the ultimate inelastic supply. A central bank can double the money supply in a week, but nature cannot double the acreage of Class A arable land. As the money supply expands, the nominal price of that fixed acreage must rise mathematically to absorb the new liquidity. This explains why, despite modest annual cash yields of 2% to 3%, the total return profile of farmland attracts capital when real yields on cash are negative. However, the smart money analysis goes deeper than just inflation hedging. It is about the embedded energy cost of calories. Modern agriculture is essentially a method of turning petroleum into food via fertilizers and diesel. As energy prices become more volatile due to geopolitical fragmentation, the cost of food production rises. Land that is naturally fertile and requires fewer chemical inputs like the rich alluvial soils Gates is targeting, becomes a low-cost producer asset. In a commodity cycle, the low-cost producer effectively holds a call option on inflation. If food prices skyrocket, their margins expand disproportionately because their input needs are lower than marginal land. This is why you see a premium paid for contiguous tracts of land in the Midwest. Scale allows for efficiency that buffers against rising input costs. The danger for the retail investor lies in misunderstanding the entry price. Just like in the 1970s, there is a risk of overpaying for the narrative. In 1981, farmland values crashed when the Federal Reserve hiked interest rates to 20%, creating the farm crisis of the 1980s. This is the crucial countersignal we must monitor. If the cost of debt exceeds the operating yield of the land for a sustained period, leverage kills the trade. Currently, we are seeing cash-rich buyers who do not rely on leverage, which makes this cycle structurally different from the debt-fueled boom of the late 70s. The buyers today are unlevered sovereigns and family offices treating land as a store of value, not a speculative flip. But there is a critical flaw in viewing land purely as soil. Land is merely a container. If you buy the container but cannot fill it, the asset is worthless. The valuation of these millions of acres is heavily dependent on a single variable that is often legally separated from the dirt itself. You can own the title to the surface, but if you do not own the rights to the fluid flowing underneath or across it, you have bought a liability, not an asset. This leads us to the second, and perhaps more ruthless, component of this trade. A market where rights are severed, banked, and auctioned to the highest bidder, turning a basic human need into a financial derivative. To the uninitiated, water is a commodity. To the sophisticated investor, it is a senior secured bond with a variable coupon. In the American West, the legal doctrine governing water is not fair share, but prior appropriation, often summarized as first in time, first in right. This legal framework creates a brutal hierarchy of capital. If you hold a senior water right dating back to 1880, you receive your full allocation even in a drought. If you hold a junior right from 1950, you are the equity holder in a bankruptcy. When the flow stops, you get zero. This binary outcome, full allocation or total loss, turns water rights into a tranche-based asset class, identical to the seniority structure in corporate debt markets. This brings us back to our mechanism map, which now evolves to explain the profit extraction. We start with inelastic supply, the aquifer or river. This flows into legal enclosure, the critical intermediary step where the right to use the resource is severed from the land itself, turning a physical molecule into a tradable financial title. This results in regulatory arbitrage, where the owner captures the spread between the low cost of agricultural water and the high price of municipal demand. T. Boone Pickens was the archetype of this arbitrage. While the media focused on his oil ventures, Pickens quietly executed one of the most significant water plays in history in the Texas Panhandle. He didn't just buy ranch land, he bought the groundwater rights to the Ogallala aquifer beneath it. The mechanism was pure price arbitrage. Farmers pay pennies per 1,000 gallons to irrigate crops. Cities like Dallas or Amarillo pay dollars per 1,000 gallons for drinking water. By severing the water from the land, Pickens converted ag water into muni water without moving a single molecule, instantly repricing the asset by a factor of 10 or 20. He wasn't farming cattle, he was farming the regulatory spread between two different types of end users. Today, this strategy has been institutionalized by firms like Water Asset Management and the Resnick family in California. The modern iteration involves water banking. This is the practice of diverting surface water during wet years, injecting it into underground aquifers for storage, and effectively creating a private reservoir. When a drought hits and spot prices for water skyrocket, these entities pump the water back out and sell it to desperate farmers or municipalities. It is the physical equivalent of buying volatility, accumulating inventory when volatility, scarcity, is low, and selling when it is high. The Kern Water Bank in California is the premier example where private control over a state-built infrastructure allows for the privatization of public resource flows. However, this trade is not risk-free, And this brings us to our necessary counterexample. Scarcity does not guarantee profit if the regulatory regime turns against you. In finance, we call this stroke of the pen risk. Water is a public trust resource in many jurisdictions. If a state government invokes the public trust doctrine, which asserts that the state has an affirmative duty to protect natural resources for the public, senior rights can be curtailed regardless of their priority date. We saw a version of this risk materialize in the Klamath Basin in the early 2000s, and more recently with the suspension of certain private water transfer applications in the Pacific Northwest. If the political cost of allowing a billionaire to export water from a drying rural community becomes too high, the property right can be diluted by emergency regulation. The paper right is worth nothing if the state forbids the physical transfer. The sophisticated capital allocating here is betting that the United States is moving toward the Australian model. In Australia's Murray-Darling Basin, water entitlements are fully unbundled from land and traded on an open electronic exchange, much like stocks. In that system, the price of water fluctuates daily based on reservoir levels, allowing for true price discovery and hedging. US investors accumulating rights now are effectively buying pre-IPO shares in a future American water market. They are positioning themselves as the market makers for the moment when water finally transitions from a public utility to a privately traded commodity. But what if you aren't trying to profit from the scarcity of a resource, but rather from the destruction of the system itself? While farmland and water rights are bets on the necessity of life, there is a third asset class that bets on the probability of chaos. This is a market where you don't buy the asset, you sell the insurance. And in a world where climate volatility is rendering traditional insurance models obsolete, the premiums for taking on tail risk have exploded to levels that make the S&P 500 look like a savings account. The third asset class in this rotation represents a fundamental shift in how capital interacts with reality. While farmland and water rights are bets on biological necessity, catastrophe bonds, or CAT bonds, are a direct monetization of physical entropy. To the average investor, these instruments look like reckless gambling, risking 100% of your principal on the hope that a hurricane does not hit Florida. But to the institutional allocators currently flooding this market with billions in capital, CAT bonds are not a gamble. They are the only asset class left that offers a scarcity rent on capital itself, completely decoupled from the Federal Reserve's monetary policy or the earnings of the S&P 500. Let us update our mechanism map for the third and final time to visualize this flow. The first box is balance sheet saturation. Insurance companies are legally required to hold capital against potential disasters. When the risk of wildfires or hurricanes rises, their balance sheets become full, and they cannot write new policies without raising more capital. This flows into the second box, securitization of tail risk. Instead of buying expensive reinsurance from a competitor, the insurer packages this disaster risk into a bond and sells it to investors. This results in the third box, the entropy premium. The investor acts as the insurer of last resort, receiving a massive yield spread for providing the capital that the traditional insurance system can no longer supply. The reason this market is exploding in 2025 is not just because the weather is getting worse, but because we are in what the industry calls a hard market. This is a technical term describing a period when insurance capital is scarce and premiums are high. Following the massive losses from Hurricane Ian in 2022 and the secondary perils of convective storms in the Midwest, traditional reinsurers pulled back. They stopped offering cheap coverage. This supply shock forced primary insurers, the companies that sell you home insurance, to go directly to Wall Street for capacity. When you buy a cat bond today, you are not betting on the weather. You are being paid a premium to provide liquidity to a capital-starved industry. The structure of the trade is critical to understanding why it acts as a hedge. When an investor buys a cat bond, their cash is not held by the insurance company. It is deposited into a special purpose vehicle, SPV, and invested in short-term US Treasury bills. The investor receives the interest from these Treasury bills plus the insurance premium paid by the sponsor. This creates a floating rate structure. If the Fed raises rates, The coupon on the cat bond rises mathematically. If inflation spikes, the yield rises. It is an asset that effectively yields risk-free rate plus fear premium. In a world of 5% cash rates and 10% insurance spreads, investors have recently seen coupons exceeding 15%, not because of speculative growth, but because the cost of renting out their balance sheet has skyrocketed. However, the smart money thesis relies heavily on the concept of zero beta. In finance, beta measures how much an asset moves in sync with the stock market. A crisis that crashes stocks, like a banking failure or a trade war, has absolutely no causal link to whether an earthquake hits Tokyo or a windstorm hits France. Physical disasters are uncorrelated with financial disasters. In 2022, when the classic 60-40 portfolio suffered one of its worst years in history, the Swiss Re Global Cat Bond Index delivered positive returns. This lack of correlation is the holy grail for portfolio construction. Billionaires are not buying these bonds solely for the high yield. They are buying them because they are the only thing in their portfolio that won't mathematically correlate to one when a recession hits. This mechanism also creates a distinct class of winners and losers in the payment chain. The losers are homeowners and businesses in high-risk zones who are seeing their insurance premiums double or triple. Those rising premiums are the cash flow source that ultimately pays the coupon to the cat bond investor. Wealth is effectively being transferred from coastal real estate owners to capital providers who are willing to underwrite the risk of living there. It is a harsh repricing of geography. The winner is the capital allocator who understands that as the physical world becomes more volatile, the price of insuring reality must go up. We must, however, address the trap risk. This is the nuance that retail investors often miss. It is possible to lose money in cat bonds even if a disaster doesn't trigger a full default. If a storm occurs that is close to the trigger threshold, the collateral can be trapped or held in the SPV for years while the losses are calculated. During this time, the investor cannot access their capital and the bond may cease paying coupons. This extension risk implies that while the asset is uncorrelated with the stock market, it is highly correlated with the efficiency of the legal and claims adjusting process. Liquidity can disappear precisely when you want it back. Furthermore, the entry of tourist capital, inexperienced money-chasing yield, can distort the market. In 2024 and 2025, we saw a record issuance of cat bonds, which typically signals a local top. When too much money floods into the space, the spreads compress, and investors stop getting paid adequately for the risk they are taking. The sophisticated play is not to blindly buy every bond, but to understand the expected loss ratio. Professional funds model the probability of the trigger event, e.g. a 2% chance of a specific hurricane strength, and ensure the coupon offers a multiple of that risk, e.g. paying 8%. If that multiple collapses because retail ETF flows are suppressing yields, the smart money exits. We have now assembled the three pillars of the anti-fragile portfolio: farmland, biological production; water rights, regulatory scarcity; and catastrophe bonds, priced entropy. Each of these assets solves a specific problem in a high-inflation, high-volatility macro regime. Farmland captures nominal GDP growth. Water rights capture the spread between agricultural and municipal value. Cat bonds capture the premium for uncorrelation. But identifying what to buy is only half the equation. The more dangerous question is when to buy. Entering these markets at the wrong valuation can be just as destructive as holding cash. To solve this, we need a quantified decision framework, a set of measurable signals that tell us when the system is flashing red. We have now examined three distinct asset classes: farmland, water rights, and catastrophe bonds, that institutional capital is using to construct a fortress against financial repression. But these assets should not be viewed in isolation. Together, they form a unified thesis we call the physical duration swap. For 40 years, the standard wealth preservation strategy was to hold paper duration. Long-term treasury bonds that paid you a yield to delay consumption. Today, billionaires are swapping that paper duration for physical duration. Assets like aquifers and soil that have a shelf life of centuries rather than 30 years. The logic is that while a Treasury bond matures and pays you back in dollars that may be worth less, a water right matures every single year by delivering a resource that is worth more. However, blind imitation is a recipe for bankruptcy. Just because Bill Gates is buying farmland does not mean you should buy a fractional farm share today at any price. To adhere to our discipline of mechanisms, not hype, we must look at the three signals that determine whether these trades are currently investable or overheated. We look at the data as it stands now in late 2025 to separate the signal from the noise. The first signal is the farmland price-to-rent ratio. This is the PE ratio of dirt. Historically, this ratio hovers around 20 to 25. Currently, in prime regions like the Midwest, it has spiked to nearly 35. This is a flashing yellow light. The last time valuations reached these levels was 1979, right before the crash. This tells us that monetary premium is already priced in. Investors are paying such a high price for the safety of the asset that the actual operating yield has been compressed to near zero. If you enter now, you are betting entirely on capital appreciation, not cash flow. A dangerous game when interest rates are non-zero. The second signal is the Reinsurance ROE, return on equity. This measures the profitability of the insurance capital providing the cat bonds. Currently, this sits near historical highs of 20 to 22%. This is a green signal for the asset class. It confirms that the hard market is still intact and that capital is scarce. As long as this ROE remains elevated, the yields on cat bonds are genuine compensation for risk, not just a bubble. The moment this ROE collapses back to single digits, it means too much capital has entered the room, and the entropy premium has been arbitraged away. The third and most critical signal is the 10-year real yield. This is the return on US Treasuries minus the expected inflation rate. As of late 2025, real yields are hovering between 1.5% and 2.0%. This is the hurdle rate. For a physical asset to make sense, it must offer a utility-adjusted return higher than this risk-free real yield. Currently, farmland cap rates are struggling to clear this hurdle without leverage, which explains why cash-rich billionaires, who don't care about financing costs, are buying, while commercial farmers, who rely on debt, are selling. The divergence between these two buyer groups is the defining tension of the current market. This brings us to our quantified if-then funnel, the decision logic that removes emotion from the trade. We assign a 65% probability to the base case of continued financial repression, a scenario where inflation remains sticky, 3 to 4%, while central banks cap yields to keep government debt serviceable. If the 10-year real yield falls below 1.0% and stays there for 4 consecutive weeks, then the physical duration trade enters its most aggressive phase. In this environment, cash is trash, and the rotation into farmland and commodities becomes a necessity for survival, regardless of high valuations. If, however, the 10-year real yield rises above 2.5%, the Volcker Light scenario, then all real asset valuations must correct downward. In this scenario, cash and short-term treasuries are the winning play. You sit on the sidelines, earn your 5 to 6% risk-free, and wait for the leverage in the farmland system to blow up, allowing you to buy the assets from distressed sellers at a 30% discount later. If we see a deflationary credit bust, the nullifier, where broad money supply contracts, then cash is the only asset that matters. In a deflationary crash, liquidity is more important than scarcity. Even water rights can drop in price if the farmers buying the water go bankrupt and cannot bid. Let's complete our mechanism map for the final time to lock this mental model in place. We started with funding source, excess liquidity, central bank printing. We moved through the intermediary, the disconnect between paper assets and physical reality. We arrive now at the macro outcome, a bifurcated economy. On one side, we have the nominal economy, stocks and bonds that may rise in price but lose value in purchasing power. On the other side, we have the real economy, assets like food, water, and insurance capacity that maintain their exchange value against human needs. The wealthy are moving from the former to the latter, not to get rich. but to ensure their capital survives the transition. We must also be clear about who pays in this transition. The mechanism of inflation is a transfer of wealth from creditors to debtors and from wage earners to asset owners. When a billionaire buys a water right and leases it back to a municipality, the taxpayer pays the scarcity rent through higher utility bills. When a pension fund buys a cat bond, the homeowner pays the entropy premium through higher insurance rates. The middle class, which holds its wealth in currency and its liabilities in floating rate debt, sits on the wrong side of every arrow in this map. They are the liquidity providers for the smart money's exit. There are no secrets in financial markets, only lags in information processing. The trade we discussed today, the rotation into scarce, essential, and uncorrelated assets, is simply the recognition that the financial system has reached the mathematical limits of debt expansion. When debt can no longer be serviced by growth, it must be serviced by inflation or default. The assets of farmland, growth, water, survival, and cat bonds, solvency, are the specific hedges against those two outcomes. This is not a call to sell everything and buy a farm in Nebraska. It is a call to audit your own personal duration. Are you holding assets that rely on the system remaining stable, or assets that function even when it doesn't? The billionaires have made their choice. They have voted with trillions of dollars that the future belongs to physics, not finance. In the next episode of Finance Saga, we will investigate the other side of this equation. The liability crisis looming over sovereign debt and the specific mechanisms central banks are preparing to bail in depositor capital. Until then, remember, in a world of infinite paper, the only true wealth is finite reality.